Hi everyone, I'm Paul and today's video is all about having an investment framework for Bitcoin. Do you have an investment framework? You really should if you don't, but the good thing is I've got one which I'm going to share with you today, so let's jump in. So the first question you might ask is, why do I need an investment framework? Why should I even bother? Well, I'm glad you asked. It's really important because an investment framework allows you to take all of your emotions out of your decision-making process. And when you're under high stress, that's really important because stress can lead to bad decision making, and so we want to create a framework that allows us to distance ourselves so we can make better decisions. The other thing a framework does is it allows us to remove our personal bias. Regardless of what you might think, you're always going to have a personal bias in terms of especially investment decisions. So for example, if you hold those securities or those assets or Bitcoin or whatever it might be, your natural inclination is you're going to want it to go up. So you need to be able to remove that lens from your decision making, and so a framework will help you to do that. Last thing that's really important is that it's easy to be influenced by bias. So there's different influences and media outlets that have an agenda or a very specific view. And so if you are consuming that content, it's unavoidable that you're going to be contaminated by that bias. So the framework helps you to eliminate that as well. The good thing about a framework is that it's repeatable, and that means that you can do it over and over again. So you'll get better at actually executing the framework, the actual process of doing it, but also it allows you to improve it over time. You can add things which you think might work better, you can take things out that don't. And the final thing that's really helpful about a framework is that ultimately it's measurable. If you're using the same framework again and again to make investment decisions, you've got a really clear result. If you're profitable, then you know your framework is working. If you're not profitable, then you know your framework isn't working and that you need to change it. And ultimately, this is the really critical thing about having an investment framework. Because it's repeatable and because it's measurable, you know whether what you're doing is working or not. So that's great. We know we need an investment framework, but how do we actually go about constructing one, especially if we've never done anything like this before? So the way that I do it is I take a top-down approach. I look specifically at price action and fundamentals or market data, and I start at the top and I start to work my way down. Now, the first thing that's really important is to understand your environment. Now, when I talk about environment, if I'm trading on the daily time frame, I use charts on a daily time frame to make my decisions. My environment is the time frames up from that. So I'd be looking at weekly charts and monthly charts. So when I go and look at those higher time frames, I'm looking at the price action to try and determine what the trend is. So if it's a bullish or a bearish trend on those particular time frames. And then I'm also looking at what are the key support and resistance levels on those time frames. And I'm going to use those analyses to then come back to the daily time frame to make my decisions. The next thing I'm going to do is look at fundamentals and market data. Now, in Bitcoin, I think the most critical things is supply, so the supply of coins in the market that are available to be purchased, investment behavior, so that is, what are the big wallets doing in the marketplace? Are they accumulating? Are they taking off exchange? What are those guys doing? And then the next thing is derivatives, because derivatives is often a bellwether of what the market is going to do, and it's also going to be responsible for some of those bigger moves that we might get on a shorter time frame. And so lastly, I take all of that information, I bring it back to that daily time frame, and I use that to try and create a hypothesis about what I think the market will do. So we've determined we need an investment framework. We've gone through the way I look at an investment framework for Bitcoin. And so what we're going to do next is jump into some practical applications of that, actually go through step by step the process that I follow in terms of forming an investment hypothesis based on the current market situation. But before we do, if you're finding this video helpful, it'd be great if you could hit that like button. That'll help other people to find it and hopefully help them out as well. Let's jump into some charts. So our first step in our framework is to look at our environment. Now, where I'm going to start is with the monthly chart, and we're going to have a look at the trend. So the trend on the monthly chart's actually quite clear. You can see here if we start at this point, we had a big run up to the first all-time highs we had sort of mid 2021. You know, we had a lower low and then that higher high that we had in November before the market pulled back, you know, right till today's date. So that's a really clear uptrend. Now, obviously, we don't know right now whether we're going to, you know, continue upwards, which would mean that that bullish trend would be continuing, or whether we're going to, you know, pull down here. And obviously that, you know, if we hit a lower low, excuse me, on the monthly, so if we came down past this level here, then we'd know that that bullish trend has failed. So at the moment, we've got a strong bullish trend on the monthly chart. Now on the weekly chart, the detail's obviously a bit more granular. You know, we can see that the trend in the early part of the year was still bullish, quite clearly bullish, right up to this point in April. So we can see that that bullish trend was intact the whole way through, but this point here it fails. So we can see we hit a lower low than the previous low, and then this high is lower than the previous high, and so that then creates this breaking of that trend. And we can see that at this point the trend has changed. So from this point in April, and this was this whole unpleasant part of the year in mid-2021. So this was clearly a bullish trend, and then this was just, you know, a trading range. So once that trading range is finished, you can see we clearly went into another bullish trend before we hit the all-time highs in November. And then again, we had a lower low and a lower high, which meant that that trend was pretty much finished from that point, and that brings us to the current day. So you can see on the monthly chart, we've had strong uptrending behavior, but the most recent trend is downwards. And so coming back to the daily chart, it's pretty clear even without drawing anything on the chart that the trend is down. And the thing that I think is important to appreciate that when you look at a chart like this is there's a lot of momentum behind the market. So even though we've had some of these big capitulation bars on the way down, you know, we had some here early on, another big one here, and then these obviously big ones in early December when we had this flush out of leverage from the market. There's a lot of momentum here. And so it takes a long time, or it takes time for that to come out of the market. So we know even on our present time frame, our daily time frame, is that the momentum is against us in terms of the market coming up. So if we look at our environment, we know on the monthly chart, we've got an intact bullish trend. We have a bearish trend on the weekly, and we have a strong bearish trend on the daily. And we know that momentum is against us. So zooming back out onto the monthly chart again, what we want to do is look at where support and resistance is on this higher time frame. So again, we're still looking at what our environment is, and we're using this higher time frame to try and isolate where we think some of the various support and resistance levels are. So what I like to do is start, you know, I call it bookending. I start at either the bottom or the top, and I just work my way into the middle. So if we look at the bottom here, you know, we've got this previous low. And if we come back up, our all-time high was up here. So we can see already we're creating a range. So what we're trying to do is narrow down the market picture of where we think price might go in the, you know, near to medium term. So if we keep moving in, you know, obviously very clear ones is we've got this previous low here. We've got the previous all-time high here. And this is really, you know, there's no hard and fast rules here, but I think the easiest thing to do is you just pick candles where you see, you know, there's more traffic, if you want to call it that. And so I think, you know, you've got them here. So you can see, like in this example, we've had closes and opens, and then we've had highs at this level. So the thing also to remember about support and resistance lines is they're not lines, they're not hard and fast. They're really zones. You know, it doesn't really have to be super precise. Very often you'll see markets shoot past these things and pull back in. So we just want to have a very good idea of these are, and that's going to give us more help in making decisions on the lower time frames. So as we come into our weekly time frame, we just want to continue that process, and that's going to give us, you know, more information in terms of making decisions on our our lower time frame. So, I can see more points here. Again, they don't have to be super accurate. You're just trying to build a better picture to make a better decision. So now as we zoom back into our daily time frame, we're just going to put the last couple of support and resistance levels in. Now, I think very clear ones are from the trading range that we've had since the beginning of the year and sort of into last year. And then there was even these sort of tighter zones here we had before the market broke down. And then this zone here, which I've talked about in other videos, which is kind of like a bit of a skip zone. And so this looks like, a bit of a mess, but I think the thing that is helpful is when you then have all this information together and, you zoom out a bit, you can see that, and we'll just highlight these, is that, there's points in the market where, support has held and been quite strong. And you can also see where, there's been zones where there's been a lot of activity, so there's been resistance there. And so that's often very helpful in terms of when we look back at where is the support. So you can see again, there was lots of activity here. So we know that there's support here. We can see even from recent price action that we've had support down in this zone here. So between 39.6 and 41.6, as there's been consistently support in this level. Whenever prices come back there, it's bounced back, and you can see we've even had touches even on this big capitulation day that the market has then come back. So that gives us confidence in terms of what the market looks like and what we can expect looking forward. So we've done our top-down analysis of price action. We know on a monthly time frame that we've got a bullish trend that's still intact, even though it hasn't completed yet. On a weekly time frame, we know that we're in a bearish trend, and on the daily time frame, we know we're also in a bearish trend. But looking at support and resistance, even though we know that momentum in terms on the short time frame, on that daily time frame, momentum is certainly against us, and it's going to take quite a bit to take that momentum to the downside away, is we can see that there's quite good support where we are. We would expect that will in the future. We also know that to the upside, there's resistance levels there, but if we can get through a few key zones, there's the potential to shoot higher. We also know that to the downside, that if we break through the key support level we're currently at, that there's not really much stopping us. And even though historically that's been support in the past, is that would be very clearly, clean air from where we are and could lead to quite a significant drop to the downside. So now that we've done that analysis of the price action, we need to look at some market fundamentals. So looking at our top-down analysis now, but looking at some more fundamentals or market data, I like to look at the Fear and Greed Index. Now, this isn't a hard and fast rule, but it's very helpful to have that sort of, broad or, very wide view of what the market is sort of and what other participants are feeling. Now, this isn't a hard and fast rule. It's not something I'd necessarily make decisions on, but it is helpful because when the market is in that, that extreme greed or that extreme fear zone, that's when you're going to get really significant movements one way or the other. Now, it doesn't necessarily mean that, say, if the market's showing extreme greed, that it can't still keep going up and it can't move explosively. But equally, you are at high risk of the market pulling back. And that's obviously when crashes happen. Equally, when it's showing an extreme greed reading, you're at risk of a bounce up from that as well. So I think it's helpful just to have that context. And as a general rule, that, old saying of, you need to be, what's Warren Buffett saying, that you need to be greedy when people are fearful and fearful when people are greedy, I think generally holds true. And so if we look at this chart, this is obviously staged at where we are in the marketplace at the moment. We've just come off a period of extreme fear ratings for the previous week, and we're not quite at those extreme levels. We're at sort of 10 and we're about 20 now, but the market's still at a very tenuous point. So one of the most important drivers in Bitcoin, what I believe is one of the most important drivers, is the issue of supply. So as we know with Bitcoin, there's a finite supply of coins that are ever going to be created. We haven't reached that point at the moment, but we're meant to get there in like 2030 or something like that. So we know there's a finite supply, and as a function of just simple, the laws of supply and demand, is that is going to dictate what the price is. And what we see when we overlay price over the total supply is that creates a vacuum upwards. The market can't stay away from that natural equilibrium for very long. So at the moment, the market's pulled below that line, and you can see, even though it can stay there for significant periods of time, it always comes back, and if it ever gets too far from that line, it pulls it back upwards. So you can see at the moment we've pulled away, similar to how we did in mid-2021. And my expectation is, again, based on just the fact that there's limited supply, is that that's going to create upward pressure. Now, if the situation was slightly different and we had a pullback and we were above the supply line, I wouldn't feel as comfortable in that position, because I know that we can vacuum down towards it. So I think at any given time, the price is going to pull back towards that supply line. So if you're above it, there's a chance you're going to pull back towards it. And if you're below it, there's a chance you're going to pull back to above it. And you can see historically, this has always held true. Whenever we move too far away from that supply line, we suck back towards it. And so the other thing we want to look at when we're thinking about supply is the amount of Bitcoin that's sitting on exchanges, so the exchange reserves. And from what we can see from this chart, it's very clearly been a decline over an extended period of time. So over more time, we see the amount of exchange reserves, amount of coins held on exchange, going down. And this is just, I guess, supporting that overall hypothesis about supply. So the more restricted supply gets, the more pressure there is on price. So we can see that the number of coins held on exchange is declining, and that hasn't changed. That, if anything, is continuing to go down, even though we've had it's not been a direct line. And so as long as that remains true, that's a bullish signal. And so one of the other things that's helpful when we're trying to understand what's happening in terms of supply, we looked at what's on exchange, is then what's actually happening in terms of the flows with the exchanges. So is there a net inflow or outflow to the exchanges? So, you can quite clearly see from this chart is that over time, there's just an increasing amount of people withdrawing from exchange. So that's taking their coins off the exchange and taking them to, either soft wallets or cold wallets or, hard wallets. And so they're not keeping those coins on exchange. And you just need to think about the psychology of that kind of behaviour. When someone's taking their coins off an exchange, the intent is that they're going to hold them. Now, how long they hold them for, that's obviously quite debatable, but clearly they're not going to be a liquid asset from a transactional perspective. And the opposite is true. If someone's putting their coins on exchange, that shows an intent that they're looking to sell those. So, we know there's finite supply. We know at the moment there's price is below that supply line, so there's going to be a gravitational force to pull back up to that supply line. We know that overwhelmingly the trend is for exchange reserves to be dropping, and we know that investor behaviour is that they're taking coins off exchange. So all of those factors are just like a constriction on supply. And I think that that's one of the most critical things in terms of the Bitcoin hypothesis, in terms of that underlying theme in our trading, is that long term there's that constriction of supply. And even on this shorter time frame, as we sort of look in the immediate term, is we can see that still holds. And so those in aggregate are still quite bullish signals. So the next thing that we want to look at, now that we've done that analysis of supply, is look at what the investment behavior is. And the great thing about cryptocurrencies is all of the information is available on the blockchain. So we can get all of that data in terms of what investors are doing. We can classify those investors and we can see what they're up to. So if we look at the screen at the moment, we're looking at Bitcoin wallet sizes above 1 Bitcoin. Now, I'd consider these to be retail investors. A Bitcoin at the moment is worth about 43,000 US dollars. And so anything sort of above that amount, it'll be below 10 Bitcoin, is still, I would think, still a retail investor. And so, we look at this chart, it's very clear that this particular group of investors has been acquiring forever. And that trend, even though if we zoom a little bit and come in at some of these times here where the market's fallen back, they've still just continually come back and been accumulating over this period. So I think that's a really great thing. That shows that there's more widespread adoption, and longer term that's a really good thing for Bitcoin in terms of its price. But the reality is these investors don't have the firepower, even though there's quite a lot of them, in terms of the ability for them to move the market. So if we look at investors with over 10 Bitcoin now, these are starting to become pretty serious investors. These are people who have about $500,000 invested in Bitcoin specifically. So we're starting to move into the realm of those sophisticated investors, and this is where we really want to start paying attention to what these people are doing. So we can see over history, historically, they've been accumulating the whole way, and then there was an inflection point here where, as the market reached these all-time highs, the number of people, or the number of investors, has dropped away, and then that stayed pretty flat. So this isn't exactly a great sign. You can see, it's kind of trended up slightly as the market's pulled back here, and they've slowly started to accumulate again. But it's certainly not a strong signal, certainly not like if you go back historically. And you can see it's this group of investors that's helped to drive the market up over time. And so at the moment, we just don't really see them participating at the rates that they were in the past. So as we shift to much more significant investors now, over 100 Bitcoin, we can see that these investors over time were really primarily responsible for driving the market upwards, all the way through, even when the market had this sort of down period here. And you can see that fundamentally changed around 2018 here, where it flatlined, and you can see it's tailed off and been pretty flat pretty much ever since. Now, that's obviously a function of having 100 Bitcoin now is a much more significant investment, and so there's going to be less and less people who can afford to be in that category. Even so, we can see that over time, that trend is definitely down, and whilst there's been some small kick-ups, like you can see here at this pullback here, there was a big spike, and a little bit of an increase here, but overall the trend is down to flat. And so finally, we have investors with over 1,000 Bitcoin. Now, these are obviously the biggest of the big whales, and we can see how active they were in terms of accumulating over the periods while Bitcoin was going up. And you can see that has changed at different points in time. And we can see here, in early 2021, that there was a steep decline. Now, if we zoom in a little bit and look at what's happening now, we can see that that's pretty much flatlined, and whilst again there's been some little kick-ups here in terms of when the markets pull back or reach lows, that there hasn't been a lot of activity from them since, and again this is flatlined. And as with the other investor classes, the more professional investors, what we'd want to see is for them to start accumulating, they'll be starting to increase, and that would obviously move in lockstep with price. And as you can see from all the charts we've looked at so far, it's only really been investors with 1 Bitcoin or over that are in that sort of accumulation phase, where everyone else is either flatlined with the occasional little peak here and there, but either flatlined to the downside. And so, none of that is really very supportive of what we'd want to see from professional investors. And so there's not a very strong case for their participation at the market at the moment, and there's no question that is a pretty bearish indicator. And so the last stop in our framework is to look at derivatives. Now, derivatives in cryptocurrency markets are an interesting one, because you have your more traditional financial institutions not able to generally get a direct exposure to Bitcoin and other cryptocurrencies. Often the only way they can get that exposure is through the derivatives market, which is generally going to be more allowable within their universe of securities that they can access. And also, just in most markets, you'll have derivatives over the top of the underlying, over that spot market. And that's where you'll also have a lot of speculation going on, because people can obviously apply leverage and take on greater positions than they otherwise would. So the derivatives market's a really good place to look in terms of getting clues as to where other market participants are positioning themselves, and also give us a bit of insight into, particularly where leverage is in the market, because depending on what happens with price, that can then, give us good insights into what the market may do in reaction to that. And so the starting point that I look at is what is the leverage like in the marketplace at the moment. And so you can see from this chart, this is the estimated leverage ratio, and basically how that's calculated is by the open interest versus the amount of on-exchange balances. Now, we know that on-exchange balances have been dropping, and obviously open interest is going up. And so you can see that at this point in time, and anyway, this estimated leverage ratio is at, historically a really high level. Much higher than it's been at other points in the market, and certainly much higher than at the market tops. So that's a sign that there's quite a lot of leverage in the system, and that can lead, especially if the market moves against those players, to an explosive move. And so when we want to understand how much activity there is in the derivatives market, we want to look at open interest. And so that's what this chart does, overlaid over the Bitcoin price. Now, interestingly, you can see when the market was at these highs here in November, that open interest was also very high. And now that we're at this position here, market's obviously come down from, almost 70,000 down here to this 43,000 mark, is that the open interest isn't as high. Now, you'll recall in the last slide, we had the estimated leverage ratio as being at all-time highs. Now, the thing that is got to be careful about and analysing that particular metric is that we know that the on-exchange balances are very low and are continuing to trend downwards, and we know that participants are pulling their coins off exchange. And so we know that those are two sort of macro trends that are going, and so as a result of that, we're going to get a slightly distorted exchange leverage ratio, because we know that the coins on exchange is depressed, if you like. And so that's part of why we need to look at what the raw data is in terms of what the open interest is. So even though that leverage ratio is high, the actual number of contracts that are out there isn't as high as you would expect. So that's quite an interesting point, but even saying that, this is still a pretty significantly high level. If we come back to earlier in the year, we can still see this is at levels that are higher than it was previously. And also the other important thing is that the leverage players haven't really been cleaned out yet. We had this high up here in November, and then we had the market fall away in early December, and that led to this sort of leverage clean out here. You can see open interest drops really savagely, and that coincides with those big capitulation candles we had on some of the charts if you look at the Bitcoin chart. So that's all highly correlated. We'd expect to see that. The thing you wouldn't normally expect is then to have the open interest just come back so quickly. So normally after a big flush out, those leverage traders are feeling a bit bruised and battered, and so it takes them a bit of time to forget their experience and come back. But in this case, you can see the open interest has come back quite quickly, and it's also come back to a high level quite quickly. So, that's an interesting backdrop, and that helps us as we sort of move through our analysis of this data and try to figure out what we think might happen next. So with the derivatives, we know that there's probably a high leverage ratio out there in the market. We know there's a lot of open interest. So we know that there's a significant amount of derivatives activity. And so the question then is, well, where are those traders positioned? Now, there's obviously buyers and sellers as in any contract, so it's not that there's more buyers and sellers or anything like that or the other. How the futures market creates equilibrium around this is through the funding rate. And so when we have traders turn bearish in the futures market, we can see we get this flip in the funding rate. And you can see this generally happens when the market pulls back. You can see here, And then generally what we'll have is a reversal afterwards. And so that's where we are at the moment. The funding rate has flipped to negative. So we know that most futures traders are taking short positions. We know that there's a lot of leverage. We know there's a lot of open interest. We know that most futures traders are positioning themselves to the short side. So the question is are any of them being liquidated at the moment? And liquidation basically means the market's moved against them, and then that forces them to close their position out. So obviously if they were long, they would have to sell. If they were short, they would have to buy. And as a consequence of that, you'll get a market movement which obviously emulates the direction that they have to close out in. Now we can see that long liquidations, as you'd expect, the market's down. We've had liquidations as we've come down, and those are pretty much tapering out. That's what we'd expect to see. On the short side, however, you can see we haven't really had any liquidations of any note as of yet. You can see if we look back here in July when the market was starting to climb again, you can see this spike in liquidations. And so this is kind of what we'd expect to see if the market turns. It obviously goes against all of those futures traders with short positions. They have to go into the market, they have to buy their positions back, and that creates what's called a short squeeze or a short covering rally. And so that's why you'll often get these really explosive movements to the upside when lots of futures traders or derivatives traders are taking a bet that the market's going to continue to fall. And so we haven't seen any evidence of that at the moment, but we know that that's how the market's positioned. So any movement in terms of the Bitcoin price to the upside has the risk for these futures traders of creating this sort of cascade up event. So now we've finished our top-down analysis, we need to bring all of that together and come up with a bit of a hypothesis, or at least some guide rails around our decision making. So we know from our price action analysis, we looked at the trends, we looked at support and resistance. We know that there's a intact trend on a monthly time frame, but that trend just breaks down when we look at it on a weekly and on a daily time frame. We also know that the momentum of the market's pretty much against us at the moment, particularly if we look at it on that daily time frame. So we know it's going to take quite a bit to arrest that trend at the moment. In saying that, if we look at the support and resistance, we know we're at a good level of support, and there doesn't seem to be a lot of evidence that will drop below that resistance above us. But also we know if we break through a few key levels that we'll skip to the upside. Looking at our fundamentals and our market data, we've got an underlying hypothesis about supply, and that still feels intact. We know that we have declining on-exchange balances. We can see that the behaviour of investors is to take those coins off exchange and put them into wallets. We also know that that long-term trend of price is that we're below that supply line, and so there's going to be this inevitable pressure to go back up towards that to bring back equilibrium. So we know that that supply is intact, so that's all quite positive. Unfortunately, when we look at investor behaviour, when we look at those wallet sizes, we can see that the retail participation is there, but the more sophisticated, the larger the investor we get, in terms of on the shorter time frame anyway, we don't really have good evidence that they're participating in the market. So that's not a really good supportive case for price going up in the short term. We want to see those investors participating, which is going to be an indicator that price is going to go up. Now, if we look at the derivatives markets, which we know we have institutions and speculators involved in, we know that there's a large amount of open interest. The estimated leverage ratio is quite high from a historical perspective, but we know that that figure has to sort of be taken with a grain of salt. We know from the funding rate that those futures traders are taking short positions, or they're positioned to the short side, but we can also see that as yet there hasn't been any liquidations of those positions at the moment. And so what does all that mean? How do we put it all together? Well, let's jump back to our daily chart and just start to apply some of those thoughts in terms of looking at the price action and trying to anticipate what we think might happen. So applying all that now to our chart and trying to come up with a hypothesis of what we think could happen, I'm fairly confident, based on just our assessment of the price action, is that there's good support down here at this level. So I'd expect anytime price retreats back to that level, we'll come back up into this zone again. So I'm feeling pretty good about that. Obviously there is the risk that if we break through that, there's nothing but free air down there. So we'd obviously want to think about our contingencies if we're worried about any shoots to the downside in terms of risk management, if we're not holding over a much longer time frame. So keeping that in mind, we know that we've got a long-term macro trend of supply in force, and we don't really see any breakdown of that in terms of what's happening on exchange or in terms of people taking their coins off exchange at the moment. So there's an indication that that's going to have, an undercurrent of support there as well. We know that those small investors, those investors that are obviously from 0 to under 10 Bitcoin, are accumulators, and that they're going to have some, but not a lot, of influence on price in terms of the direction at the moment. Our biggest thing we need to think about is the derivatives traders at the moment. So we know their position to the short side. We know that we're at this key position in the marketplace at the moment. Obviously what they want is that they want to see a break of this support level and a shot to the downside, because in terms of a risk reward for them, this is all free air, and we could end up down here at this 33 mark or down under 30,000. That's obviously the kind of positioning that they're playing for. The risk to them though is, keeping in mind that their leverage is that whenever the market starts to go up, and the question will be is where are these key points that are going to make them pop. And so it's generally going to be at sort of round numbers. They're going to have stops here, but you would have to think that if the market gets back up to this sort of 45.56 mark, is that that's going to be a place where we'll start to see liquidations take place. Now, that may happen on the way up. You may start to see gradual liquidations, and that starts to create its own momentum, and then we get to that sort of ultimate pain point where the majority of those leverage traders get squeezed out, and then that creates another shoot upwards as well. So I think that that's probably the more likely scenario at this point, is that we'll see, potentially a little bit of a grinding down here for a little bit of time before we see a press up. Now, we might have a little shoot up and then maybe pull back again before we maybe go to the upside. So I think that sort of thing is the most likely scenario in terms of a shorter term thing. I think that we will see price start to gravitate slowly upwards, and that'll create some initial pain for those short traders. The other thing to keep in mind too, the longer this sort of sideways action goes, the less conviction a lot of those traders are going to have, and they have to fund those positions as well, and so they're going to start exiting if that this sideways action goes on for too long. So that's the other thing to keep in mind as well. This sideways action is their enemy as well, because they're funding those positions. So there's sort of two things working against them. We can range trade here for a while. Any sort of upward move, it is going to work against them, and that's going to create upward pressure on price, which could cascade if the price keeps shooting upwards. Now, I think that the areas where we're going to see the most resistance is through here, not as much through here, and then again through here. So I wouldn't be surprised if we see, price get stuck in these zones for a little bit, but could quite possibly skip through those. Now, obviously, this is the danger for a lot of those leverage traders. As I said, we get some sideways action here maybe, and then they start to close positions, and we get a slow move upwards. That triggers a cascade of liquidations, even if we grind in here for a little bit. But if we get anywhere up near here, you'd have to think that most of those leverage traders are going to get squeezed out at that point. Very likely would lead to a explosion to the upside. So this is why having an investment framework is helpful. We obviously can't predict anything with certainty. What it does give us is the ability to sort of step outside our own position and, really objectively look at what the other participants in the market are doing, what they want to happen, and about what that will mean in terms of the price action. So there you go. There's my investment framework. If you don't have one, obviously feel free to use that. I hope that's going to be helpful in terms of your investment journey. If you already have one, leave a comment. I'd be really interested to hear about what you do when you're making your investment decisions. And if you enjoyed this video, if you learned something from this video, it'd be great if you could hit that like button. And obviously, if you want to see more videos like this from me, subscribe to my channel, and I'll see you in the next video.